Without further ado, I would like to introduce our first speaker for today, Mr. Damo Sojanto, Chief Investment Strategist, UOB AM Invest. Damo is responsible for providing leadership in the investment aspect of UOB AM's digital platform. He also concurrently heads the Investment Partnerships and Solutions Unit at UOB AM, managing the firm's strategic tie-ups and investment initiatives with external managers. Damo has over 20 years of investment and research experience in the finance industry. Over to you, Damo.
Thank you, Bernice. Good afternoon, ladies and gentlemen. Thank you for joining us this afternoon. Before I start my presentation, maybe I'd like to have run a poll to have a sense of what you think or what's the sentiment on the ground in terms of which type of fintech do you believe would disrupt the investment industry the most, right? So you should see it on your chat, the possible answers for this question. Which type of fintech do you think would disrupt the investment industry the most? Is it A, AI, B, blockchain and cryptocurrency, or 3, big data? Okay. I'm seeing someone says AI, big data. Okay. Good. I think it's roughly split between AI and big data. I'm glad that you are quite well in tune in what's happening in the industry. Let me then start talking about the fintech development in investment management. I think there's actually quite a lot of new development in this area. The days in which that we think of investment management or fund management being an analyst looking through annual reports, that's probably still the impression, but I'll probably need to tell you that that's probably a bit outdated. Let me talk a bit on what has been developing in this industry, and if you're thinking of joining this industry, what are the sort of the recent developments and how things have changed. But taking one step back, we've actually seen fintech being flourishing in the whole finance industry. And we see the major development in fintech. For example, in payment technology, we have e-wallets and micropayments that's now being accepted very widely. In the past, we would never been able to say, I want to transfer 20 cents or 30 cents or $1 to a friend, or I want to make payment of 30 cents because the transaction cost itself was prohibitive. Today, I think we don't think anything about making micropayments through whether our phones through our phones. So basically, this is actually a very major step in terms of fintech. Lending tech, I think if you've been following, there's peer-to-peer lending and micro lending, as well as AI-based credit assessment. Those are all the technology that's been happening in the world. In insurance tech, again, we have micro insurance, and then we have sort of data-driven insurance sales and underwriting. Nowadays, if you are prepared to allow your insurance company monitor your heart rate, you can get a discount on your health insurance premium. So those are some of the how people are using data and technology to basically customize the insurance underwriting. But all these, I guess, UOB AM is an investment management company. We are a fund manager. So I think what I want to focus today's talk would be fintech in the investment and wealth management industry. Okay, so I'll probably, roughly speaking, cover two areas. One is on the investment process itself. Two is in terms of how we do, in terms of investment advisory and distribution. I think these are probably the two areas that I want to focus on. Using technology in investment has been around for quite some time, right? The first quant-based hedge fund started in 1988, D.E. Shaw. So that's about uh, almost 30 years ago, right? So the first time we used computer algorithm to run investments was actually about 30 years ago. And the first exchange traded fund started trading in 1993. That's the SPDR, the S&P 500, and today is still the largest ETFs around. And so basically using computer algorithm to create to track the index and therefore uh, create a passive investment vehicle is actually started more than about 27 years ago. And the first smart beta ETF is now about 20 years old. What I mean by smart beta ETF, I think we all know ETF as a passive vehicle in terms of replicating the market indices like your S&P 500, or in Singapore the Straits Times Index. You buy a fund that basically track that index and basically replicate that index. I think for smart beta ETF, it started off fairly simply. For example, we all know that the S&P 500 index is a market cap weighted index. So basically, the composition of the ETF is based on market weight of the index. The first smart beta ETF actually started off by thinking, what if instead of doing market cap weighted, we do equal weight ETF? And what they found was that having an equal weight ETF actually outperformed the market cap weighted ETF, right? And the reason was actually fairly simple. When we drilled down, they realized that if you do you do equal weighted, what happened is that you end up buying more of the smaller cap and less of the bigger caps, right? And all along, what we've seen is that smaller cap stocks tends to grow faster than large cap stocks, simply because the law of large numbers, right? So the small caps tends to grow faster. And because of that, the equal weight ETF ended up beating the sort of the large cap weighted or the market cap weighted ETF. Then later, especially during the GFC, someone says, hey, what if we do an ETF that is volatility weighted? So instead of market cap weighted, you do a volatility weighted. So if the volatility of the stock is high, it has a lower weightage. And if you have a lower volatility, you have a higher weight in the ETF itself, right? So that's what we call equal risk parity portfolio, or volatility weighted portfolio. And they realize that that sort of portfolio actually can deliver a market return at lower volatility. So those are what ended up being what they created as smart beta ETF, right? So basically trying to create ETF that doesn't really track the the market cap index, but using other form of weightage. So those are what we call smart beta ETF, and it actually started in the year 2000. Why did I talk so much about all this? We spoke all this. I spoke all this basically is to talk about the foundation have now actually been laid into factor investing. So if you think about it, today, smart beta ETF, we have smart beta ETFs in that covers various factors. So if you think of the equal weight ETF, an equal weight ETF actually, if anything, is really buying more into small caps than large caps. So it's really what we call a size factor, right? You're investing in a size factor. And there are now ETFs that invest in growth factor. For example, if you create an ETF that basically invests in stocks that has the fastest growth, that's investing in growth factor. And there are now standard indices that basically tracks growth factor, right? So instead of the MSCI US, you have MSCI US growth. And there's now also value factor. So besides MSCI US, you have MSCI US value. So basically, stocks that are the cheapest or the offer the best value. So these are what we call factor investing. But the next step is really, instead of doing just single factor, people are looking at a multi-factor portfolio. And so instead of uh, emphasizing on any one particular factor, okay, I'll take a step back. Uh, the idea is that not most factors don't perform all the time, right? So if you look at the original thesis in factor investing, Pharma and French basically say the only factor that persists is value. But if you look at the last few years, value has actually not performed. And in fact, the factor that's performed is really the growth factor. Today, the idea is that instead of focusing on one single factor, you have a portfolio in which that you have multiple factors in the portfolio itself. And the idea is to use artificial intelligence and machine learning to try and figure out which factor is the appropriate factor to emphasize on. I'll give you an example. If if the economy is slowing and companies are not growing, then investors actually tend to flock towards growth stock. As everyone chases after whatever growth there is. And therefore, the portfolio should tilt towards the growth factor, right? Whereas when you're coming out of a recession and everyone is sort of growing, or the whole economy is growing and most of companies are growing, under those circumstances, usually the value factor is the one that tends to perform. So what the aim today is that portfolio manager wants a multi-factor portfolio that can tilt to the right factor at the right time. And basically, it's a matter of using artificial intelligence or human judgment to figure out what is the right factor to apply at the right time. I think that's probably one of the major trends that's developing in the investment industry. The second way that we are using excuse me, that we are using technology and helping us manage our investment is this what we call financial sentiment analysis. And we actually use it to detect sentiment whether to market or to specific stock. And we use basically technology to listen in what we call digital listening, to figure out unstructured data on natural language processing, to listen in to whether people talking on stock forums or looking at news reports or looking at analyst reports, and trying to determine whether a stock or the market is seeing positive or negative sentiment. And the idea is that you want to write that sentiment when it is improving. You buy when the sentiment is improving, and you sell if the sentiment is deteriorating, right? However, at extreme, that is when you want to play contrarian, meaning that when there is euphoria and market is one side is getting too positive on one side, that's when you might want to think about selling your position. And if market is depressive, meaning the market is very, very bearish, that's a time that you may want to step in and buy, right? So that's playing contrarian at the extreme, but riding the sentiment when there's a trend. The third area that we are seeing in terms of technology or fintech being used in investment is in where we see big data or alternative data being used. Okay, we are now analyzing investments using what we call high frequency data, simply because traditional data may be too slow. Imagine that your GDP data comes out at the end of the quarter with a 1 month lag, right? for us to basically try to ascertain what is happening in the economy, that's really too late. You're actually almost a few months late. So now people are actually using things like satellite photos, credit card information to basically try and detect what the economic activity is. Right. So you've seen cases in which that you take the satellite data of lights in China to get a sense whether economy is improving or deteriorating. And the reason is this: when in the past, when economy was booming and uh, industrial production was companies or factories had to churn out production 24/7, you actually see lights that is burning very brightly in China or in certain parts of China. You actually see factory lights uh, burning uh, throughout the night, right? So those were indication that factories are running 24/7, and therefore you can tell that the economy is doing well. Whereas when economy deteriorated and factories don't have to run night shift, lights were actually much dimmer. Another form of using satellite photo is like we've heard of cases in which that people look at, and this is in the US, people look at parking lots. So if a supermarket is or a strip mall is busy, you see that the parking lots are full. Whereas if you see that parking lots are not full, then you know that shopping activity has actually sort of has deteriorated. So that's the sense of how these malls or how these supermarkets like Walmart are doing simply by looking at satellite photo of the parking lots. Credit card information gives us a picture of consumption, but if you can drill down further in terms of where that consumption is going, that's also very useful. Online shopping site prices, that's basically to use what we have seen is that people use online shopping site prices to measure what is your consumer price index, your CPI index, or your inflation picture on a real-time basis, rather than waiting for your CPI number that comes out end of the month with a 1 month, with a few days, for a few weeks lag. Right. So with online shopping prices, you actually get instant data of how CPI number is actually changing. Job listing ads basically shows the employment situation, the employment condition, but it also shows a few things. In the past, we used, for example, I know of colleagues who basically counted what are the number of ad pages on SPH on your Straits Times newspaper to get a sense of how the SPH is doing. And for companies, basically, if your company is growing, uh, the number of job openings should be increasing. So people actually also track job openings in the company, job listing ads in the company to figure out if the company is doing well or not, right? Other examples that we see is using, like, for example, traffic congestion and air pollution data to get a sense of how the economy is, especially now, we're talking about how the economy is recovering from COVID. People are actually tracking traffic congestion and air pollution data as a way to figure out whether the economy has recovered. And if you use a baseline of what we call pre-COVID baseline, then you basically would know if at what stage or how much the economy has recovered from the baseline. Restaurant booking is another good example that people are using to track how economies are recovering from this COVID virus. This is the US number, but it's probably the same across the world. What we've seen was that restaurant bookings collapsed because of the lockdown, and after that, it starts recovering. But from here, what we are actually seeing is that the recovery has sort of stalled at about 60% of the original level, meaning that we are currently seeing about 60% of activity level compared to the beginning of this year. So if you look compared to the March lockdown, it definitely has recovered quite significantly, but compared to pre-COVID, we've actually still quite some some time away. So these are what we call high frequency data that we use in order to analyze the situation, right? And in tech, when we talk about fintech and investment, I don't think we can run away from cryptocurrency and blockchain. And the idea is this: in cryptocurrency, um, for us, we sort of recognize and we basically acknowledge that we are not good at trying to figure out how to price cryptocurrency. And the answer is this: because we tend to look at assets as something that generate cash flow in future, right? And then we know how to discount that future cash flow, and we know how to price the assets. Whereas for some assets that rely on scarcity value, on relying on what the next person is willing to pay for that asset, we acknowledge that we don't know how to price those because we simply don't know how the next person is going to price how much the next person is willing to pay for that asset. That's why for cryptocurrency, at least in UOBAM, we do not see it as an asset class, and we don't include it in our analysis, right? We recognize that blockchain holds potential. There are a lot of talks of how blockchain may be used in future. There's some people who think that blockchain may be used to replace, say, stock market or stock exchanges. But actually, from our point of view, we think that the value will be more on the back end because if you look on the front end and says that, look, instead of having a exchange, everyone will now trade with everyone else. That's basically the picture you see on the left-hand side, right? Is you need to have every node in the market connect with every other node and store that information. And you can see just on a sort of 12 participant kind of market, there is so much various connection that's required. Whereas the right hand side basically is the arrangement of having a centralized exchange and things actually look so much cleaner. And so we think from a arrangement point of view, it seems to make more sense to continue to having a centralized exchange in terms of having this centralized exchange in terms of trading. Where the value of blockchain is probably in terms of back-end settlement when we have uh, brokers and fund managers and custodians uh, having that connection and having that automatic uh, smart contract or having that information that is shared that that reduces the need for, say, um, human intervention or having the need for human reconciliation at the end of the day. Having a blockchain or having a distributed ledger would mean that everyone's information is the same, and therefore you can do away with all the day end reconciliation and settlement. I think that makes a lot more sense for blockchain. But at this moment, it is actually still not matured enough in the sense that the volume and the speed that is required cannot is still not there yet. That definitely is something that we're keeping an eye on. Right. So I've come somewhere to the midpoint of my presentation. Maybe at this stage, we'll talk. I want to hold another poll and to see uh, what you think about robo-advisor, whether you have invested with a robo-advisor before, right? So
Okay, just a bit of housekeeping. For those who are not familiar with Microsoft Teams, you can actually go to the chat box. You'll see some activity there right now. Just key in your answer. And if you have any other questions that you would like to post, do feel free to key in your questions in this chat box as well.
great. I see quite a number of you Excuse me. I see quite a number of you who've actually invested a robo before. That's great. Okay, so it's largely split between A and B, yes and no. Okay, good. Let me go into it then. A robo-advisor is probably one of the fintech development in what we call investment advisory and investment distribution, meaning that this is not the investment process itself, but how investment is being distributed or being sold to customers. And robo-advisor basically is one of the sort of recent developments. It's probably launched in 2008 in the US. There's the first robo-advisor called Betterment, and it started taking money from investors in 2010. So what's a robo-advisor? It's basically a computer program based on mathematical rules or algorithm that helps you manage your investment. And this is done with minimal to moderate human intervention. That's sort of the uh, industry accepted definition of robo-advisor. And in the basically what robo-advisor has done is leveled the playing field between investors and financial advisors. In the past, there are such software for financial advisors that help them design um, the sort of investment portfolio for clients. But the introduction of robo-advisors to the end investors themselves basically leveled that playing field. So instead of relying on financial advisor, you can now use the same tool and design your own portfolio. And it's basically the algorithm is actually the sort of in the industry is what's widely used tends to be based on what we call modern portfolio theory and sort of the efficient frontier. If you're not familiar with this term, it's okay. But to give you an idea, robo-advisor would typically ask you some question to determine what is your risk profile, what is your risk tolerance, and also what is your investment horizon. And from there, they sort of create a portfolio for you of the different asset classes that you should be holding that fits your risk profile. So if you're aggressive, they'll put more equities in your portfolio. If you are more conservative, they'll put more bonds in your portfolio. But the whole idea is that generally everyone should have a balance or should have a multi-asset portfolio of different asset classes to diversify your risk. And then from there, the robo-advisor would basically rebalance your portfolio regularly to make sure that your portfolio continues to stay according to its own design, right? Oh, sorry. Oh, sorry. And to round up, basically, in terms of the development in robo-advisory, I think today most robo-advisors tends to be plain vanilla as how I described, right? Determining your risk profile, determining your investment horizon, then allocating your portfolio. Going forward, I think there's probably a few interesting and exciting development in robo-advisory. This is not being implemented yet. I think there's no, it's probably not done yet, but it's something that we are seeing brewing in the industry. One is what we call tactical asset allocation. For example, today you have a portfolio of 50-50 in terms of stocks and bonds, right? But what if we see that a recession is coming? We are going into a recession. Excuse me. We all know that in recession, we should be buying more bonds because that's more defensive, and we should be buying less stocks. And in a recovery, we should be buying more stocks and less bonds, right? So that's what we call tactical asset allocation. And currently, tactical asset allocation is being implemented in solutions that we offer to institutional investors. So basically, in institutional mandates, we actually advise clients to do that according to the economic condition or according to economic cycles. So gradually we think that this is going to be incorporated in your robo-advisor too, meaning that if the AI or if the algorithm detects that we see a recession coming, we should automatically adjust your portfolio to to reduce that risk for your portfolio and increase the defensiveness. Whereas when we see a recovery, we should actually try to and increase the risk assets. So those are basically what we would expect going forward in terms of robo-advisory. The second trend that we see is incorporating value investments. That means incorporating a client's and investors' own values, meaning that whether it's ESG or impact investing in your portfolio. So if you say that currently we can analyze and says this is the current impact that your portfolio is having, or the ESG that your portfolio is having in terms of carbon emission and everything, we might in future, we might allow you to say, I want to improve the ESG factor, meaning that I want to improve the impact my portfolio has on society. And gradually, we would probably allow client to do that. That's definitely part of the plans that we have. And then the third one is what we call life cycle investment, meaning that, for example, if someone is investing for their retirement, and healthcare costs, rising healthcare costs is something that people are worried about, then basically, if you think of it, maybe we should include a healthcare fund in your portfolio to to basically hedge against rising healthcare costs. Right. So those are what we call life cycle investment. If you are investing to, say, for example, for your house, then we should incorporate, say, for example, a real estate fund that would probably benefit from rising housing prices, and therefore it hedges you against rising property price. Right. So these are some of the things that can be incorporated into your portfolio as part of life cycle investment. It is not there yet, but it's definitely something that the industry is thinking about. And to round up, basically in terms of the tech and fintech and investment advisory, currently what we are seeing is independent research platforms, meaning that there are platforms that that allows analysts or ex-analysts to basically publish their research, and basically they are paid based on the number of downloads that they receive. So those are what we call independent research platform. And then we see crowdsourced portfolio, meaning that you have sites that basically uh, let the users or let users vote in terms of what they think is the most popular ideas, and create a portfolio out of that. So those are what we call crowdsourced portfolio. You can participate in one of those crowdsourced portfolio, or there is also things like investment idea replication. You have sites or platforms in which that traders or people basically pitch their investment idea, and then you see which investors or which traders has the best track record, and then you basically can follow their investment ideas, and you can basically replicate their investment ideas. And these traders or investors are being paid by the number of followers that they have. So these are some of the areas in which the investment advisory, we are seeing fintech developments or fintech investments in this sort of investment advisory. Okay, I've come to the end of my presentation. Thank you for all your attention. I'm now happy to take on any questions that you may have.
So next up, the next speaker we have with us is Ryan Sun, UOB resident data scientist. Ryan is responsible for solving complex investment problem statements using AI and machine learning. Working closely with business units across organizations, he has helped develop models that enhances the business and investment processes. In addition, he's also helping the company to enable new technologies for the company by collaborating with tech firms and universities. So some of the questions that I do see in the chat will be answered during Ryan's session, and there's also a short Q&A after that. So do feel free to keep the questions coming. Okay, so Ryan, over to you.
Hey, hi. Thank you, Bernice. Can you hear me?
Yes, loud and clear.
Okay. Okay, thank you. Hi, everyone. Thank you for staying with us. I'm Ryan, and I will be going through in depth on the AI topic and how maybe some of the future employees can work well with the rapid changes that's happening in the industry. First of all, maybe I would like to show you a short video created by the World Economic Forum on AI and big data topic.
The time of spreadsheets is over. A Google search, a passport scan, a barcode reading in a supermarket, your online shopping history, an EKG reading, CCTV footage, a photo of a sandwich, a voice message, a tweet. All of these contain data that can be collected, analyzed, and monetized. Supercomputers and algorithms allow us to make sense of increasingly larger amounts of information in real time. In less than 10 years, CPUs are expected to reach the processing power of the human brain. A survey done by the Global Agenda Council on the future of software in society shows that people expect artificial intelligence machines to be part of a company's board of directors by 2026. There is a good chance that in 15 years, your job is going to be performed by computers, since decisions once based on experience and intuition will be made through machine analysis of massive amounts of data. Think about a vehicle that is able to read its environment and react accordingly, much like a human driver, but also analyzing other sources of information that will make the trip safer, faster, and more efficient. Analyzing vast amounts of medical data from different locations and demographics will allow to determine which conditions improve the effectiveness of certain treatments and which don't. Big data analysis will reveal patterns and connections that will vastly improve most human activity.
Okay, that's all for the video. So, from the video, we know that digital data is actually increasing exponentially, and is indeed increasing exponentially across the world, not only in volume, but also in velocity and variety too. We have now have data such as your social media data. We have even Instagram pictures, so many videos from YouTube and everywhere, and all this data actually can be a value. We are able to so-called process them correctly, and this is where AI come in. AI and its algorithm can actually make sense or generate insight efficiently without relying on human bias on those big data. So AI actually is a very broad field with many applications, but in asset management, the key usage is to use AI to process big data to, again, generate the insights and using them in our investment and business processes. And this will lead us to new growth opportunities and also higher efficiency across the business value chain. Previously, Damo, my director, has presented to you a lot of use cases or maybe on some of the AI that we use in so-called our business and investment processes. And now we're going to dive in deep into one of the models that we actually developed. So regarding investment, the way to use it is actually, again, what Damo has presented, to harness all the insights from various data points, like, from credit card, traffic, electricity usage of region. And some of this data could be unstructured data. What I mean by unstructured data is these data are not, perfectly numbers where you can put into an Excel spreadsheet. Pictures like, data like pictures, photographs of the satellite photograph, all these are considered unstructured data. And we have actually be able to refine and also develop an AI model that can process all this data as a whole to generate a very accurate macroeconomic forecast for a region. So let's look at the model. So we have all the data as inputs, like, as mentioned, satellite data, news articles, which is also considered unstructured data because they are not really have well-defined fields. Sometimes it's just a paragraph or maybe an entire article. And also, very fast, rapid data coming in from transaction, like credit card transaction data. And actually, we can all this data, and we develop in Python the AI model using, actually for now, we are using so-called open source libraries. You can search on it. It's like, we are using scikit-learn. example, and inside we actually build an example model using algorithms such as linear regressions, which you all have done before, but it's another way of processing inside so-called the data science. And also we use another algorithm called extreme gradient boost, XGB for short. So we create them into a stacking ensemble, and we actually process all this data, and we can generate the recession forecast probabilities. Okay, this is the output for two regime macroeconomic forecast, which is whether it's a recession or not. But our actual model, which I'm not showing here, has even better, can display even better details, such as the transition between non-recession and recession period. We can actually detect that also. So before even the recession happen, we can actually get ready to let the fund managers know, there could be a recession coming, and it's quite considered now still quite accurate even with the COVID situation. So how do we process all those unstructured data? So like satellite data, where we want to maybe use the satellite data to determine traffic condition. We actually also created another neural network, it's called another AI model. This time we are using the algorithms with a convolution neural network. And train FCNN stands for train fully connected neural network, which is another term used in data science. So actually it's just a convolution neural network. This is one of the algorithms that you can use to process pictures. But actually when you process pictures, you must also train the model to understand, okay, based on this kind of pictures, what is the outbound traffic from scale from 0 to 100? How shall they map the numbers to the pictures? And what is the inbound traffic, etc. And we create this structured data output that was fed into the part of the data set which we shown earlier. Likewise, for news articles, we also create another so-called AI model, which is we use the algorithm this time from Google. We have developed this model algorithm called BERT, which is is one of the breakthrough in recent years in natural language processing. So you can actually Google on this. This is really a very neat algorithm, very smart algorithm or structure created by Google using deep learning neural networks. And it's able to understand the context of the document very well. And it can generate the sentiment based on we can train it to generate the sentiment of the articles. And again, once we take this unstructured data, we generate into a structured output, which is again part of the input data shown earlier in this model, where we generate for the recession forecast. And this is how a typical AI model is developed when we need to so-called ingest so-called unstructured data. So we have links of many AI models left and right to have the final output. So what is the other AI use case for asset management firms? Because Damo was very focused on the investment side, the front office side. So we also have other things that we can do with AI across the business, such as advanced customer analytics, which is we can understand the customer life cycle, maybe the customer churn, why are they churning, and etc. So we can also understand what is the things that maybe can, what are the marketing promotion that can target them more effectively. And also operation intelligence. We are also using AI to give us insights on how to automate more intelligently. This is belong to a new technology stack called robotic process automation. Actually, you can Google on this. This is one of the big things happening across the industry, not only for finance, but across the entire verticals, horizontals also, so-called in the other industry also. Robotic process automation, and now we are on the third generation where we actually infuse AI into this robotics process automation. And of course, risk performance and also compliance, like you want to detect frauds, you want to detect money laundering. There are some patterns that the AI can pick up. And because AI, you just run it as a program, it can run non-stop. It doesn't require human to, keep on looking at the logs and trying to, where human can only look at 1 or 2 dimension, AI can take all the data in and generate into one site at one go. So how do we achieve innovation in UOB asset management? The management do know that not everyone is a technology person. UOB asset management has come a long way, has a long history. There's many staff that's very experienced, and UOB asset management value them immensely. So we are looking at this model called the T-shaped teams, which is actually coined by in the industry. It's not really so-called specific to UOB asset management or the finance industry. But the CFA Institute has mentioned about this also, T-shaped teams. You can search on this. It means that you see on the top bar, the bar or the horizontal bar is the technology teams. And the vertical bar represent all the business units and the investment units. So they have very deep knowledge on their domains, their expertise. Then we gel them together, and I belong to the technology team, but also belong to the gelling part where I'm with the business innovation, where I take in all the ideas from business teams, and then we translate into technology solution for them. It seems simple, but actually going forward, the business team members also shall have sufficiently broad technical knowledge to work well with people in technology. What I mean by this is because, business is always, only business people know what is needed for the business, correct? And they have so many years of domain knowledge and expertise. So if they have good understanding about what technology can do, they can come out with very useful use cases and can be translated into technology solutions. So that's why for UOB AM, we are going to, the company is always improving the technological knowledge for all the staff across the business. By doing digital culture and awareness events, every year, every other quarter, we have all these, Dabao for digital, this kind of lunch events. We also invite speakers to show us what is the latest use case of all the technologies, and also what can be done to improve their, to use technology to improve their efficiency. And also UOB and UOB AM also has invest a lot in upskilling the employees, such as, the UOB Bank itself has brought the whole suite of courses from Lincoln Learning and give all the staff for free. You want to learn any course from Lincoln Learning, the staff can take it at their own time. And UOB AM has also further improved on this and brought a lot of courses from DataCamp, one of the online course so-called providers, and also to allow the employees to even upskill on their programming knowledge also. And finally, we also engage a lot of POCs with external technology firms such as Google, the Google research team itself. And we also engage a university, which is NUS, for project partnerships. We have developed, we are actually now also in progress with one of the professors from the finance and to develop a new model for our business. So there's so many changes in the industry, not only for finance, also across the board. Our management do think that going future, they do like to, let's say with employees coming in, the first and foremost thing is you must be good at what you do. Because let's say you are a fund manager, then you must be very good at picking funds, securities, and for your own job, correct? So you must have very good knowledge and expertise in your own domain. So that's the first thing. It's still the most important thing. Okay, it doesn't mean that technology is coming in. You cannot, you just focus all your effort, some of your effort to technology and forget what you want to do, what you're supposed to do. But yet you must be tech savvy, as what we mentioned in the T-shaped teams. The person should actually keep on understanding, keep their understanding of so-called technology around the world. I don't know whether you heard of this term called IoT, Internet of Things. I'm sure maybe most of you have heard of it, or maybe even artificial intelligence. Okay, this artificial intelligence term, right, is coined over 60 years ago. More than 60 years ago, people already say, no, artificial intelligence is there, is coming. But the use cases and the capabilities of AI 60 years ago and now is very vastly different. So what I mean is that even okay, what is AI? You know what's the AI for year 2020. But maybe in year 2030, the capabilities of AI has changed already. So what I mean is that, yes, you know AI, you maybe know the AI now, but you must keep in touch of, let's say, what is developing in the AI field. What are the new use cases? What are the new capabilities? As now I mentioned, Google developed this BERT, which this BERT, BERT technique, which actually progressed the NLP field so much. So like IoT, IoT was like coined maybe 20, 30 years ago, but now, IoT is really going to like even incorporating 5G, edge devices, edge processing, all these, you must really keep yourself in touch. Maybe read some of the new so-called technology magazines online, or etc. And also maybe emerging technology. One of the emerging technology I see is relevant also to finance is quantum computing. As you all know, sometimes quantum computing actually is getting more real, maybe by the day. And like Google, they already have a very a lot of organizations are always developing on it. And JP Morgan also has started to use, I saw the articles, they have used quantum computing in computing like correlations of all assets in the world, almost real time. That's the capability of quantum computing. So you can build like the real-time efficient frontier, etc. So not only have to be tech savvy, you also must be broaden your mind to have be a change savvy. So you must also know how to, okay, you know about all these techs, or whatever, it's a good knowledge. But how do you incorporate them into your own work? Like, okay, let's say, I'll give an example, which is related to our current, one of the AI models we are developing now. Let's say you are a research analyst. Yeah, you need to read like 200 to 300 research reports every month, correct? I mean, it's good to read, definitely, you shall read in depth, but maybe you think that only 20, maybe 20 source of the articles is good, and you want to really take your time to read in depth of it, but you still have like 200 articles that you want to read, but maybe you don't have time to read it. So, but that, like Google, they has developed this very good NLP technology. So you think, oh, can I use some kind of AI model to help me pick up the most important point, the most important topic, the sentiment across all the articles? So you, and then you approach so-called the technology team like me, like, okay, say, hey, Ryan, what can I do? I have this use case. Can you help me develop a model? And yes, this is what you mean by change savvy. You must always continue to think of ways to use technology to change your life for better, make yourself more efficient.